Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Hello, everybody. Welcome to another edition of the mentorpodcast.com. So welcome, Dr. Adam.
Thanks so much for having me. It's good to be here. Thanks.
And guess what he does? He raises money for folks. In case, if you're not interested in raising the money, you might as well tune out right now. No, don't do that. So I got some questions for him because he raises money by using crowdfunding, which has always been of interest to me. I just never got around to doing it, even as many projects as I do. I've done several private placements, which I guess kind of is crowdfunding, but not, because my private placements were all sold to people that I know and have a relationship with, and those days might be over for many. Tell us who you are and why they should be listening to you.
Oh my goodness. Well, first you should be listening to me because I have an amazing West Texas accent that is always attractive, I think, to people. What do I do? So we build digital marketing systems. We build basically crowdfunding platforms, although that's a bit of a misnomer. Our clients manage approximately, over 35 billion in AUM and have raised probably over $1 billion using our system. That's small checks all along the way, right? It's over the last 10 years. So you actually nailed it on the head, Ron. If you've done a private placement, you have syndicated a real estate deal. You've sold securities, technically speaking. You've sold securities, raised money, and sold securities in a real estate business, whatever that was, value add multifamily, whatever it is. Crowdfunding, the only difference between a real estate syndication and crowdfunding, even though it's a misnomer, is that today you can solicit those investments. You can sell those securities to people you don't know. And that's really the only difference. And so what that does is it opens up the world to you to be able to advertise online and to have a website that says, invest with me. That's really the only difference.
Okay. So we got three ways we can raise money and satisfy the SEC, which, by the way, you don't want to dance with that gorilla. I spent 3.5 years dancing with him. I made one mistake. You know what it was? I was in a seminar and I actually took somebody's money before they got the document. Had the document at home. Took the money before they got the document. 3.5 years for that. Okay, so anyway, got out of that one. So in the kind of a private placement that I did, you had to have some kind of a relationship with your investors. That was 506B. So, and then there's a 506C. Is that what you do a crowdfunding with? C?
Yeah, exactly. So the difference between a 506B, so it's very technical, Regulation D, 506B, restricts you to soliciting investors or soliciting investment only from people with whom you have a pre-existing relationship. So friends, relatives, country club members that you know, whatever, right? That's the only thing. 506C allows you to raise money online. You can raise money from people you've never met, never ever talked to, right? That's really the difference. It's not really, I mean, the term is used for is crowdfunding, but really it's just not having a relationship. That's really the difference.
In fact, you hear commercials from people advertising projects that they've got that you can invest in. Not very many years back, that wouldn't be allowed.
Correct.
In fact, it wasn't allowed when I was raising capital. Mine was prior to 2008. All right, so rules, they got to be accredited investor.
Correct.
Explain that, please.
An accredited investor, is somebody that has $200,000 of income for the last 2 years, or $300,000 if they file together with a spouse, and a reasonable chance of earning the same or more this year, or $1 million of net worth, not including your primary residence. That's there are a few other types of accredited investment. Those are the basic ones.
All right. So if we want to raise a fund to whatever we want to raise it for, we can do all kinds of advertising and drive people to a page or a webinar, or just to get their phone number or their email address so we can send them stuff. So we got to generate leads and follow up on those leads, just like we do in almost any other business, especially the one here at Global. So a lot of those leads you can get for free on social media. A lot of them you're going to have to pay for. And I can tell you right now, the ones you're going to have to pay for are going to be better leads than the ones you get from SEO. Tell me how you guys go about getting people to come to see the offer.
Well, actually, I'm not so sure that if I may be so bold, that I do agree with you. I think somebody that finds you organically through SEO, search engine optimization, establishes a relationship with you by engaging with your content online, and then decides that they want to invest. That's a high quality lead, right? Rather than somebody who has, just been bombarded with ads on Facebook. Those are really, really tough leads to crack. This is what you need to do to be successful in raising money online. You can surely pay, do paid advertising to drive prospects to a page or to sign up for a webinar. You could do that, but you would be a lot more effective if you have a solid website first that explains who you are, your background, your track record, your investment thesis, your investment philosophy, et cetera, et cetera. Because what happens when somebody sees a paid ad is the first thing, especially if you're asking them to invest tens or hundreds of thousands of dollars, what are they going to do? They're going to research you. They're going to find out, even if they sign up for the webinar, they're going to do research on you. So what you want to do is to make that research as easy as you possibly can for them. Make it as easy as possible for them to research you. More importantly, to learn about you, what you want them to know. Right? So you want them to, your website needs to cover everything about you and everything about the way you invest and why you want to invest and what you're investing in, why you like the asset class, etc. And then your prospects will learn who you are. And when they actually engage with you, guess what? They are predisposed to investing with you. All they want to know is where to send the check. That's what they want to know. Instead of asking you, instead of letting that webinar do all the heavy lifting, right? You don't want a 1 hour webinar to have to engage, nurture, and convert.
I got it. Okay. Now, before I go any further and we lose our audience, what if I don't know anything about marketing and don't even know how to get that website set up? I'm out of business, or I imagine there's ways to get you to do that for them.
Yeah, well, that's right. Just call us. We'll help you do it. Exactly. Right. That's exactly what we do. Okay.
Well, exactly why I'm talking to you, sir, because I know my students aren't going to do it themselves. Now, there might be a few of them that could do it themselves. So make sure that we talk about how you're going to get paid here before we get this through. What has to go in? Let's say I'm buying an apartment complex. What kind of documents am I going to need to satisfy the public's requirement for information, or anybody else's for that matter? Or just give me an idea what I'm going to have to put together before we even start asking for money.
As you establish a relationship with a prospect, right? You're always going to establish a relationship, whether you have a pre-existing one or not. You've still got to establish, they need to know who you are. So you got to educate them on who you are, your background, and your experience, right? So that's not really a document. It could be articles, it could be videos. There needs to be the word I want to use, panoply of content that really explains who you are. And you can put that, right. If you want to, you can put that up on YouTube or on your website. Yeah. But is your question are you asking legal documents? Is that what you're asking, or are you asking for something?
Well, sure. I want to know what I have to provide to be legal. I've had enough of the SEC. I really don't want a return visit.
All right. So you need to hire a securities attorney to put together offering documents for you.
Okay.
And the offering documents, we don't get into the details of those, but those describe the risks and the business plan and et cetera, and make sure that somebody's accredited and they jump through the right hoops to be accredited. There's various legal requirements. You also need a pitch deck, right? You got to have a pitch deck that explains exactly what it is in the business that you're trying to engage, that you're trying to raise money for. So you want to have a pitch deck as well that goes through. And those, by the way, Ron, those should be structured. There's a formula for how to structure a pitch deck effectively. So the formula should be like this.
Well, explain what pitch deck means first.
A pitch deck is essentially, oftentimes it's a PowerPoint presentation that will walk prospects through what it is that you are raising money for, why they should invest, and give them the opportunity to make a decision at the end.
How I'm going to get paid back, when am I going to get paid back, and what can I expect, things like that.
Exactly, yes.
And then, of course, all the PPMs I've ever done, you have to put all these reasons why they shouldn't invest in this because they're going to lose their money.
Yes, that's exactly right. You've got to have the risks.
Investors are used to that. They read that all the time, and they know it's required. So that's really never been an issue for me. All right. So all I'm doing is putting together a package on me and a package on the project that I have in mind with the facts that are current, not projecting anything or certainly no rates of return and certainly no guarantees if I'm going to get it through my attorney.
No, you definitely want to be describing the projected returns. You can't possibly raise money without projecting returns. All you can't do is you can't guarantee it. And you need to be sure that let people know that they are projections, and you may not hit those projections, but you've got to project.
Anyway, it's a pile of documents that your attorney's going to write. Or do you guys?
Well, no, your pitch deck you will write your own pitch deck. The pitch deck is what you put in front of your prospects. What they sign is what your lawyers
PPM,
will put together.
PPM with your operating agreement in it. All right, so your pitch deck is just a bunch of stuff about you and all the details about any projects that you have in mind of funding, right?
Basically, specifically, it would have a call to action at the end. Yeah,
like anybody'd want to know. So it's kind of common sense, but there's a lot of things going in that you probably wouldn't think about if you don't have an expert working with you on that. So do you put together pitch decks, or are we responsible for that?
Yeah, we do. We work with our clients once we build out the platform for them. The educational platform that explains everything about them. We then work on marketing. One of those things is pitch decks. Yes.
Okay. Mm-hmm. All right. So you would suggest that we have a project under contract before we start, because probably don't want to sell a blind pool, do you?
It's easier to sell an individual deal than it is to raise money for an individual deal than it is to raise money for a fund. Because,
I mean, that's doable. Of course, we got to go through the due diligence process on any project that we buy. So sometimes that can take at least a couple of months. So I'd say you need at least 3 to 4 months or longer before we could close, providing we have a project.
So when you're raising money, you've got to have a deal to raise money for. If you're going to do a fund, that's fine. But they're harder to raise money, because in a fund, all you're doing is you're describing the broad sweeps of what it is that you want to invest in. It's an investment thesis that you're raising money for. Mm-hmm. Whereas if you raise money for an individual deal, you can say that the building at the corner of Walk and Crosswalk in Main Street, whatever, America, right? Downtown America, wherever it is. This is the building that we're going to be buying. These are the characteristics of it. Here's the market. Here's our business plan. This is how we're going to invest. This is how you're going to make money out of it. You can actually point to a specific deal. If you're raising money for a fund, you're just saying this type of deal is the kind of deal that we're going to be raising money for. So it's a heavier lift on the educational side. You got to educate people. What is a fund? How does a fund work? When do you call money? How do I know what you're going to be investing in, et cetera, et cetera? It's harder to do a fund.
Well, if you've got a property under contract, my question is how long do we need it under contract before we can close to get this pitch deck done? PPM shouldn't take long and do my due diligence, because I'd be giving them an earnest money deposit, but it's refundable if for any reason that I want to back out. So I'm kind of lost on how that's going to work. I put the project under contract, then we start raising money for it. But a lot of things can go wrong. What if we start raising money for a project and we don't take that project?
Well, you can't raise money. Okay, so you cannot raise money or take money in for something you're not going to do, right? That's illegal. So you don't want to do that.
Well, but they've already given us money, so we have to give it back to them, or give their permission to use it for the next project, or what? Or give them the choice.
Right. So if you're going to, so let's say let's pick a specific deal. Let's say you got a deal that you're in escrow for, right? You've got earnest money down. It's not hard yet. It's refundable earnest money. You're doing due diligence. And at the same time, you're raising equity capital, right? You're going out to investors. You say, hey, invest in this deal. We're doing due diligence. You can choose how you want to do it. You can say, look, this thing won't close. Please make a soft commitment. And then once you go hard on your money, you know you're going to close, then you could bring that capital in. Again, I'm not a lawyer.
That's the answer. We don't take their money until we know we're going to close.
You don't want to be taking anybody's money until you got a real deal. Or if you do, put it into an escrow account. So if you don't close the deal, the escrow agency knows to send the money back.
Yeah, we'd have to do that anyway. So we would probably raise money for the equity if a loan was available for the rest, but then might have to raise money for the whole thing if lenders tighten up like they did in 2008, which I knew you were around for. It was bloody for me, man. It was bloody. I had developments going in 9 different states.
Oh, my goodness.
And it didn't work out well after September of 2008. All right. Well, anyway, I find that the hardest thing about doing one of these things is figuring out what you're going to pay your investors and to make it worthwhile to entice them to actually send you money. What's your idea on what kind of yields they're looking for out there in the marketplace today?
Okay, so we did a study with investor management systems. We analyzed $1 trillion of real estate investments. And I can tell you exactly what is market. So you want to be having an 8% for the most common preferred return is an 8% preferred return. By the way, this was before interest rates went up. So it's possible that there is upward pressure on that, but 8% is a kind of baseline minimum preferred return. And then it really depends on the kind of deal that you've got, right? If you've got a higher risk deal, you want to be today, probably realistically, you want to be, you got to have a conservative projection of probably mid to high teen IRR over the life of the deal. But, for the more conservative investors or sponsors will be offering lower internal rates of return because they're going to be taking on less debt, leveraging less, and therefore protecting the downside more. So it really depends on what your appetite is for risk and what your investor's appetite is for risk.
And what your project can provide.
And it also, if you're going to buy a Class A fully leased, industrial building that's leased to Amazon on a 20-year lease, you might be comfortable with a 6 or 7% return on. I don't know what that might be today. But if you're going to do a ground up multifamily somewhere in LA where you don't have entitlement, you're going to have a much higher projected return because the risk you've got construction risk, entitlement risk, construction risk, market risk, got much more risks. So you got to be sure that you're going to deliver higher returns to compensate for that.
Would you say that the market agrees with that the self-storage and mobile home parks and apartments would fall into the low risk category? It
really depends on the sponsor, Ron. You could have a mediocre sponsor could fail on a good deal. But an excellent sponsor could do very well on a mediocre deal. So it's less the asset class and more the quality of the sponsor and how they execute on the business plan.
Most likely, our listeners would be buying something that needs to be turned around and then stabilized and build in the equity. I guess that is understandable to investors as long as they explain to them exactly what we intend to do and what's the upside. Yes.
Well, yes, exactly. That's everything about real estate and raising capital is about education and teaching people what it is that you're planning to do in an effective, easy to understand way that is backed up by good analytics, good market studies, good research, and good experience.
And good greed from investors.
Greed is a good thing, but also pragmatism today. What investors are looking for more than anything is not to lose money.
That means you better have a good analysis built that you can actually trust and probably be conservative on it. But you can also adjust your offer based on the risks that are for example, you think it's going to take a year to turn it around. You make it 2 years to turn it around in your offer, so you come out better. Then you look like a hero, especially on the next raise you do. On mobile home parks, for example, our goal is to find sellers directly. Well, we can go to agents as well to get as much seller financing as we can, and then raise the rest with a fund. But we're buying them well below market value, so we have an upside already built in after we take some of the money we raised and put it into the project. Make sense?
Yes, makes sense.
Okay. So tell me, rattle off what kind of services you provide for your clients exactly.
So we build investor acquisition systems. What that means is that typically what we do is we'll build a website, or we'll take your existing website. We will create and install on it tens of thousands of words of content, articles that are high value, articles that describe your investment thesis, background, the way that you see the world, et cetera, et cetera. We create videos as well. We push them out on social media. So we fragment all of that content into small sound bites, push it out on social media with calls to action, links back to the website. So now what starts happening is you create this flywheel of activity. People see you on social media, specifically LinkedIn, Twitter, and Facebook are the best ones for commercial real estate. People then navigate to your website. They learn who you are. They get to know, like, and trust you, and they decide, I'm going to sign up on your website with a lead generation form. We build all of this. Lead generation form that says, hey, sign up for my newsletter or get on the wait list for the next deal. Give me a name and email address. And as soon as a prospect enters name and email address, we set up automated responsive emails that go out, welcome sequences that go out, might be 3 or 4 emails that go out over the period of a week that now nurture that prospect and teach them who you are, why they should stick around. Then you also need to have a newsletter that goes out. You got to be communicating at least once a month, minimum once a month, with high value, not just pitch stuff, but high value educational content about what's going on in the general industry as it pertains to your asset class. And then you want to be pitching. And we do all of it. And we do everything. We build the webinars, we do the paid advertising, we create the lead funnel, the lead generation funnels, we do the social media marketing, we do everything for you if you want. Or if you want us to show you how to do it, we can show you how to do it as well. But our main business is we build these systems ourselves.
Yeah. Well, the next question is obviously going to be, how do you get paid?
So we're a fee-based company, cannot take a percentage of a raise. We don't do that. It's a violation of SEC laws, and we don't step over those lines. So we're fee-based, and that's what we do. There's a set fee to build a system for you. It runs for 6 months to build out a robust investor acquisition system, capital formation system. And then we move to a marketing program. So if you want to do Facebook ads or Google ads or any kind of paid advertising and unpaid marketing, we charge a monthly fee to manage that up to a certain amount that you might spend each month. Some of our clients, for example, will spend 150,000 a month on paid advertising to attract investors. But you don't want to do that unless you've got a really good foundation first, because the first thing, like I said, the first thing anyone's going to do when they see you, they're going to do research. They want to know who you are. So make sure that you've got the answers to those inevitable, predictable questions already there, easy to access for your prospects.
Okay, but you didn't tell me how you get paid.
We get paid a fee. We are paid a fee. We charge a fee to build the system each month, flat fee each month.
How do you determine the fee, Adam?
So it's set fee. It's not a percentage of anything. It's a set fee for the work that we do. And we don't get any percentage of any kind of raise.
Okay, well, if it's a set fee, does that fee vary with the type of project or not?
No, it's I'll tell you exactly what we charge. So our minimum fee
would be nice
each month. So we start at $15,000 a month for 6 months. If you want to do search engine optimization, and if you want us to build your website, can go up to 30,000. So between 15 and 30,000 a month for 6 months to build out an investor acquisition system. And then after we built the system, then you move to paid advertising. We charge a set fee around $5,000 a month up to $20,000 of ad spend. And then we charge 20% of any ad spend that you have on top of that. Above 25,000 a month.
And of course, all of that can be reimbursed out of the fund.
Absolutely. Yeah. It's a cost. It's a line item. It's like hiring a plumber, basically. We're less than it depends. If you're doing a multifamily value add, we're less than the plumber.
We got a lot of people watching that are in the single family house business.
Yeah.
Suppose they want to just raise some money to buy up a bunch of houses, which we all know very, very well. You ever seen a private placement for that?
Yeah, sure. I mean, there are some very, very big shops. I used to work at just after the global financial crisis, 2008 or so. I was I was brought into Colony Capital, and Colony actually established a single family home for rent business actually, and we bought. I don't know, at least tens of thousands of single-family homes, loans on single-family homes. So we ended up owning tens of thousands of these homes. And Tom Barrack, who was the head of the shop at that time, decided, why don't we rent them? And so that's what he did. And that was all syndicated capital and debt, FDIC debt, actually. But for a smaller participant, somebody who's looking to buy 2-3 homes at a time,
I ain't worth the trouble for that.
Well, no, you've still got to have the same. You've still got to educate people. Why do it one person at a time?
Well, that's what I said. For only 3 homes, it ain't worth going through all of that stuff you just described. I want our folks to think a lot bigger than that. For example, what if I raise $20 million based on buying all the homes that I can under the certain criteria that I'm probably going to be describing? You know, I ain't going to pay retail price for a house. In fact, what you just mentioned just now, you fund the guys, buy a lot of properties from our investors out there, not buy from them, buy them, your competition with them. But, we know stuff you don't know. I bet you I could have got your yield up to about 45% with just a couple of tweaks. But it's too late now. Anyway, that's what we do. We buy them and then we lease them out, get a big multi-$1,000 deposit, non-refundable, and put the repairs onto the tenant buyer. Raises the yield through the roof.
Interesting.
So, and we get seller financing on a lot of them, or we take over existing debt on them. So we could do a single family. We just got to figure out what is it we're targeting and what are we willing to give back to the investors. Now, you mentioned a preferred return a while ago. You better make sure everybody understands what that means.
Okay, so a preferred return in a syndicated real estate deal is the first money that comes out. All right. So the way that it looks like this is like this. So when you buy a property and you do the upgrades and then sell it, you make profit, but you don't know exactly how much profit you're going to make. So you would ask not on day one, right? You only know when you actually sell it, how much profit you're going to make. So the deal that you would have with your investors is you would say something like this. You would say, all right, invest in my deal, but invest $10,000, $100,000, whatever, $25,000, $50,000 in my deal. And I will, out of the profits, out of either cash flow or profits, basically cash available for distribution, wherever it comes from, you would say you will get we will pay you 8%. That's the preferred return. We will pay you 8% on your investment per year. That's the first money before me as the sponsor, before I even get any share of the money.
Assuming the project generates it.
Assuming the project, cash available from distribution.
Right.
Then what I'll do, you would say typically, is you would say out of the next amount of money that comes out of this project, right, the profit, then I'm going to pay you back all your money, right? So the first thing that happens out the profit is you're going to get an 8% return, preferred return per year.
Per annum.
Then once you've got that 8%, then I'll give you all your money back. And then we'll split the profits. Whatever's left over, we will split. That's called the promote, as the term used is the promote. And the promote can be, anything that you want it to be. Typically, it's going to be an 80-20 or 70-30 split. In other words, the investors will get 80% or 70%, and you will get 30% or 20%, whatever, right? 80-20, 70-30. That's typical. But what is also typical in commercial real estate finance is that as the sponsor, you will also have money in the deal. You will also have some of your own money in the deal. It's called skin in the game. So if you're raising $1 million for a deal, you might tell if you have no money in the deal, how can you explain to investors, I've got nothing. I want all of your money. Right? You can do that. And there are people that do that, but there's no alignment of interest. You do not stand to lose. So you want to have an alignment of interest. You want to have 5 or 10% of your own money in the deal as well.
I've done it 5 times. I'm doing all the friggin' work, man. I don't want to put in the money too. I mean, I earn my money because without that, they're not getting any. So basically what you're saying is an 8% return, but let's say you want to give them a 15% return, 8% of it is in from the rents, and the rest of it will be paid to them when they either sell or refinance.
Well, it depends how you do. It depends how you structure the deal, Ron. Yeah, you can have different hurdles. Mm-hmm. So you might have an 8% preferred return to let's call it an 80-20 split, right? Where you get 20 as the sponsor, they get 80. Then when you hit a 15% return, out of those profits, you might go to a 60-40 split. So that's called a tiered waterfall. So you can certainly structure your deal that way. It's not uncommon.
Yeah, that's the problem. We got to figure out, look at the numbers and make sure you can believe them, and then figure out how you're going to pay your investors. It was always my problem. You better make sure the property is going to produce the revenue. And of course, our properties might not be break even when we buy them, but a few months later, we can get them to start making money. I get all that. We analyze the risk and put them all in there, but we're never going to get them all. All right. So tell us how we get a hold of you, sir.
Thank you. Yes. So I can be reached at Gower. My website is Gower Crowd. That's my last name, Gower, gowercrowd.com. And the best way to reach me is sign up for our newsletter. It's free. You can always unsubscribe. You'll get an email from me on a Wednesday, and you can reply to that. If you want, that comes straight through to me.
Spell it out for us.
GOWERCROWD, gowercrowd.com.
Okay. You have a phone number people can call?
Sure. 213 761 1000. And I also have an email address. You want my email address?
Well, of course. I wouldn't have thought of that.
Okay. Adam@gowercrowd.com.
Okay. Got it.
All right.
All right. I hope all of our listeners got it. You know what might just have happened in the last 30 minutes, Adam?
What's that? They all went to sleep?
The one out of the 500 that are paying attention might decide to do something with this information and literally make them filthy, stinking rich.
That's exactly right. Yeah.
But that's the problem with information. you gotta turn it into implementation or nothing happens.
That's exactly right. Isn't that the truth, Ron? That's wise words indeed.
You will be hearing from us very soon. I can tell you that. So, guys, I hope you understand what just happened here. You just heard the man that can do all of the work for you, raise the money for you to get into larger projects. And that brings up another question. Okay, let's say I want to buy an apartment complex. I've never done one before. Would you strongly suggest that I bring somebody on the team that has a good track record of buying apartments and then figure out how to pay them? I mean, I'm not saying give them 50%, guys, but figure out how to probably give them just equity.
Yeah, absolutely. You've got to have experience to be effective. You need to have experience, and the best experience you can have is, unfortunately, by having failed. So really what you want to be looking for is somebody who's been through a cycle, ideally somebody who went through the global financial crisis at least, and knows what happens when the market turns against you, because then you will be setting yourself up for long-term success, not quick buck money, right? Quick buck money always, that's Vegas. Always going to come to an end, that game.
And that same person could also guarantee the first loan on the property if you make it worth their while.
Well, if they've got deep enough pockets and they're okay being a guarantor on the loan, sure, you have to pay them for that, presumably.
Or just get non-recourse loans, which you're not going to do if the property's not stabilized. So that's the whole use for crowdfunding. Get the money to turn it around and buy it, probably go down the road and refinance it on a 40-year loan. When the interest rates drop back down, that is. And I'll either sell it or hold on to it. The older I get, the more I want to hold on to them. I have a hard time making people understand why the more you hold the property, the more money you're going to make. But anyway, that's here or there. Well, you are fun to talk to. Great job answering a lot of questions.
You're a very good host, by the way. You have very clear, easy to understand. I hope I'm answering them properly, but it's enjoyable being with you.
You did. And you cleared up a lot of things for me. I just did this for me. You know that, don't you?
Yeah, it's totally fine. It's just the best way to do it.
Share it with everybody else.
No, it's a really good idea. It's like, you know what? Instead of speaking hypothetically, we speak specifically and practically. It's a lot more useful, actually.
Amen.
Case studies, like the Harvard case study method in real time.
What city are you in, by the way?
I am actually on the west coast of California, central coast. Today I'm in San Luis Obispo, small town right in between LA and San Francisco. Where are you, Ron?
I'm in Jacksonville, Florida.
Oh, hey, $1.5 billion lottery winners in Jacksonville. Did you check your lottery ticket yet?
I saw it, and no, it wasn't me.
Otherwise, we wouldn't be talking now, would we?
So, hey, you live in California.
Yeah.
What's the difference between Titanic and California?
Titanic? Oh, it's a joke. I don't know. What's the difference?
It's a joke.
Titanic already sank into the sea. Is that the idea?
No. When Titanic went down, the lights were on. All right. It was a feeble attempt.
It's all right. No problem. Well, hey, you're in Florida. That state is on fire at the moment. It's incredible.
Oh, yeah.
What's going on in Florida?
Some areas it's dropping values, but it's not doing like it did in 2008.
Well, we have a client that owns most of Tampa and St. Petersburg office, and they are full. They're on fire. And we have clients in LA whose buildings, downtown skyrises, are half empty. I mean, it's a tale of two worlds. Florida is doing very well.
Bet it's probably a tale of two marketers. One is and one isn't. Would be my guess.
Marketing is absolutely critical. You're absolutely right. You should always be marketing.
It's the most important talent you can possess, regardless what industry you're in.
Especially when everybody else goes on defense, it's the perfect time to go on offense and start marketing hard. Yeah.
Companies start having a hard time. The first thing they cut is the marketing.
Yes.
It should be the last thing they cut.
It's the other way around. Yes, that's right. But you got to do effective marketing. Otherwise you piss money away. Excuse my language.
There you go. All right, guys, last time, write it down. GOWERCROUD.com.
CROWD.
I'm sorry, I wrote W and I said you.
Crowd. Right. Yeah, like crowdfunding.
Yeah,
Gower crowd.
Okay.
Yeah.
Well, Adam, thanks a lot. I bet you we'll be doing one of these in the not too distant future. And if you want,
Ron, it's a pleasure to me. I've heard your name for a long time. So I was so thrilled to get on your podcast. Thank you.
Some of it is true.
Just don't know which bits. That's the only thing.
Thank you, sir.
Yeah, thank you for having me.
The time. All right.
Yeah, my pleasure.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.